My neighbor Greg sold everything in November of 2008. His 401k was down 42%. He moved it all to cash. Took him 3 years to get back in. By then, the market had already recovered and hit new highs. He lost 7 years of retirement. Not because of the crash, because of what he did next. There's this guy in Florida, retired accountant, 71 years old, calls into a financial radio show last month. His portfolio is worth $1.2 million. He's terrified. Reads headlines every morning about market concentration, about how 7 tech companies now control a third of the S&P 500, about how it looks exactly like 2000 all over again. He wants to sell half his stocks, sit in cash, wait for the crash. The host asks him one question. When are you planning to get back in? Dead silence. 30 seconds of dead air. Because here's what nobody tells you. The scary part isn't the crash. It's that you'll have no idea when to come back. I want to show you why the thing that keeps you up at night, the market crash everyone's predicting for 2026, is not actually the thing that will ruin your retirement. And more importantly, I want to show you the one decision that separates retirees who make it through any market from the ones who don't. Because I've been tracking this data for 15 years, I've got multiple hundreds of thousands of dollars in the market myself, and the pattern is so consistent, it's almost boring. Here's what we're going to do. I'm going to explain how the psychology of market crashes actually works, why your brain is wired to make exactly the wrong move at exactly the wrong time, and the specific framework that keeps portfolios alive when everything around you is screaming to sell. No motivational talk, just the data nobody wants you to see. So let's start with the thing everyone's panicking about right now, market concentration. And I'm going to explain this through something that happened in a completely different industry because the psychology is identical. Back in 1987, there was this shopping mall in Minnesota, biggest mall in America. And there were 2 stores that basically funded the entire thing, Bloomingdale's and Macy's. They were the anchors. 38% of all the foot traffic, 38% of all the revenue. The mall owners were terrified. What happens if one of them leaves? What happens if department stores die? They had consultants telling them to diversify, to spread the risk, to not be so dependent on 2 giant tenants. You know what they did? Nothing. They doubled down, built an even bigger mall, put even more eggs in the anchor tenant basket. And for 20 years, people said it was dangerous. Too much concentration. One sector. Too risky. The mall's still there. Still profitable. Because here's the thing about concentration. It feels dangerous when you're in it, but danger and risk are not the same thing. Danger is the feeling. Risk is the math. And most people, especially retirees, can't tell the difference. Right now, 7 companies, Apple, Microsoft, Google, Amazon, Meta, Tesla, Nvidia, they make up 34% of the S&P 500, more than a third. That's the highest concentration we've seen since March of 2000, right before the dot-com bubble exploded and the NASDAQ dropped 78%. So when Morningstar runs a headline saying your index fund might be riskier than the internet bubble, people listen because it feels dangerous. But here's where it gets interesting. I pulled the data on every time in the last 100 years that market concentration hit extreme levels like this, 7 times. You'd think each time was followed by a crash, right? That's what your brain wants to believe. That's what the headlines want you to believe. 5 out of 7 times, the market went up the next year. Not down, up. After 2008, when concentration spiked during the financial crisis, the market climbed. After COVID, same thing. Concentration hit extreme levels and the market ripped higher for 2 years straight. So if you're sitting there thinking concentration equals crash, you're not reading the data. You're reading your fear. And that's the first place retirees lose money. They confuse the feeling of danger with actual risk. The market doesn't crash because a few stocks are big. It crashes when those companies stop making money, or when credit freezes, or when something structural breaks. Concentration just makes the ride more volatile. And volatility is not the same as loss. Now you're probably thinking, okay, but what about 2000? What about when it did crash? Fair point. So let me tell you about a guy named Bill. Not his real name, but the story is real. I used to do consulting work with small business owners, and Bill was one of them. Sold his company in 1999 for $4.3 million. retired at 52. Put everything in tech stocks because that's what was hot. Cisco, Intel, Oracle, the works. By 2003, his portfolio was worth 1.1 million. Lost 3/4 of his wealth. But here's the part that matters. Bill's brother, Tom, also retired in 1999. Similar net worth, but Tom was boring. 60% stocks, 40% bonds. Mix of sectors. When the crash came, Tom's portfolio dropped 28%. Painful, but survivable. By 2006, Tom was back to his original number and climbing. Bill, he panic sold in 2001, sat in cash for years, and never fully recovered. Two brothers, same starting point. One understood concentration risk and diversified. The other chased returns and paid for it. But even then, even after losing 75%, Bill could have made it back if he just stayed in and rebalanced. The crash didn't kill his retirement. Selling at the bottom did. And that's the pattern you see over and over and over again when you actually read the studies. Morgan Stanley did this analysis tracking real investor behavior during 2008. They looked at when people pulled money out of retirement accounts and when they put it back in. Standard 60-40 portfolio, 60% stocks, 40% bonds. If you just held it, you were down 31% at the worst point. 2 years later, fully recovered. But the average investor, they sold somewhere near the bottom. Not quite at the lowest point, but close. And they didn't come back in until the recovery was already underway. By the end, they underperformed the do-nothing strategy by 18%. 18%. That's not a rounding error. That's the difference between retiring comfortably and working 3 more years. And it wasn't because they were dumb. It was because their brains are wired to do exactly the wrong thing under stress. There's this concept in behavioral finance called recency bias. Your brain overweights recent events when making predictions about the future. So when the market drops 20% in 6 weeks, your brain doesn't think, well, historically this recovers. Your brain thinks, this is the new normal. It's going to keep falling. I need to get out now. And the financial media, because they're incentivized by clicks, not by accuracy, they amplify that fear. Every talking head on TV has a reason why this time is different, why this crash is the big one, why you need to act now. I'm going to show you how often that's been true. Vanguard did a study looking at every market pullback of 5% or more, going back decades. They tracked what happened if you sold and moved to cash. If you stayed in cash for 3 months, you underperformed 61% of the time. If you stayed out for 6 months, 72% of the time. If you stayed out for a full year, like a lot of people did in 2008 and 2009, you underperformed 79% of the time. The median gap, 9%. Think about what that means. Almost 8 out of 10 times, selling during a crash and waiting costs you money, not saves you money, costs you money. Because the biggest up days in the market happen right after the biggest down days. And if you're sitting in cash trying to wait for the perfect moment to get back in, you miss them. And those days are the entire return. Let me give you a specific example with real numbers so you can see how this actually plays out. Let's say you're 60 years old in January of 2008. You've got $800,000 in your 401k, 60% stocks, 40% bonds. You're planning to retire in 5 years at 65. The market crashes. By March of 2009, your account is down to $550,000. You've lost $250,000 in 14 months. You're sick to your stomach. You can't sleep. Every time you check your account, it's worse. So you sell. You move everything to cash. You tell yourself you'll get back in when things stabilize. But here's what happens. The market bottoms in March of 2009 and starts climbing. But you don't know it's the bottom. Nobody does. It could go lower. So you wait. You wait through April, through May. By June, the market's up 24% from the bottom, but the news is still terrible. Unemployment is still rising. Europe is a mess. You wait. By December, the market's up 53% from the bottom. Now you're really stuck. Do you buy in after it's already up that much? What if it crashes again? So you wait longer. Finally, in late 2010, you get back in. The market's up 70% from the bottom. Your $550,000 in cash is still $550,000. If you just held your 60-40 portfolio and done nothing, rebalanced once a year, by the time you got back in, you'd have had $760,000. You'd have made back most of the loss. Instead, you locked in the loss and missed the recovery. By the time you actually retire in 2013, the person who stayed invested has $1.1 million. You have $820,000. Same starting point, $280,000 difference. And the only thing that caused it was the decision to sell. Now, I can already hear the objection, yeah, but what if you'd sold at the top? What if you'd seen the crash coming and gotten out in October of 2007 before it fell? Then you'd be a genius, right? Okay. Let's say you did. Let's say you're the 1 in 1,000 people who actually timed it perfectly. You sold everything in October of 2007. The market crashes. You're sitting in cash, feeling brilliant. But now you've got the same problem. When do you get back in? You have to time it twice. You have to get out at the top and get back in at the bottom. And statistically, almost nobody does this. The odds of timing it correctly once are low. The odds of doing it twice are basically zero. Fidelity did this study, looked at their best performing retirement accounts over a 20-year period. Want to know what they found? The best performing accounts belong to people who forgot they had them. Dead people. People who literally died and their accounts just sat there, untouched, compounding. Second best? People who forgot their passwords. I'm not joking. The people who couldn't log in to panic sell outperformed the people who were actively managing their accounts. What does that tell you? It tells you the biggest risk to your retirement isn't the market. It's you, your brain, your emotions, your need to do something when the best move is to do nothing. And this is where most financial advice completely misses the point. They'll tell you to diversify, to rebalance, to have a plan. All true, all useful. But they don't tell you that the plan only works if you can actually follow it when your account is down 40% and your brother-in-law is telling you he moved everything to cash and slept great last night. That's the real test. And most people fail it. So here's what smart retirees do differently. And I don't mean smart like high IQ. I mean smart like they understand how their own brains work and they plan for it. 3 specific things. First, they build a portfolio they can actually stomach. This is not about optimal. This is about survivable. If you're 62 years old and you've got 1.5 million saved and the thought of losing 40% in a crash makes you physically ill, then you probably shouldn't be in a 90% stock portfolio. I don't care what the Monte Carlo simulation says about your odds of running out of money. If you can't handle the volatility, you will sell at the bottom and turn a temporary loss into a permanent one. Better to have a 70-30 or 60-40 split that you can actually hold through a downturn than a 90-10 split that you'll abandon the first time things get scary. The best portfolio is the one you'll stick with, not the one with the highest theoretical return. Second, they separate their money into time buckets. This is something I learned from the fiscal lawyers I worked with for years. You don't treat all your money the same. Money you need in the next 2 years goes in cash or short-term bonds. Untouchable. Money you need in years 3 through 7 goes in a more conservative mix, maybe 50-50 stocks and bonds. Money you won't need for a decade or more, that can be aggressive, 80 or 90% stocks, because you've got time to ride out the volatility. When you structure it this way, it doesn't matter if the stock market crashes next year. Your near-term money is safe. You're not forced to sell anything at the bottom. And psychologically, it's way easier to watch your decade-out bucket drop 30% when you know you're not touching it anyway. Third, and this is the one that sounds simple, but almost nobody does, they stop looking at their accounts. I'm serious. The more often you check your portfolio, the worse your returns. There's actual data on this. Researchers gave 2 groups of people the same portfolio. One group could check it every day. The other group could only check it once a year. The daily checkers made more trades, sold more often during downturns, and underperformed by 4% annually. 4%, just from looking too much. Your brain is wired to respond to loss more strongly than gain. Psychologists call it loss aversion. Losing $100 hurts about twice as much as gaining $100 feels good. So when you check your account every day during a volatile market, you're exposing your brain to way more pain signals than pleasure signals, even if the overall trend is up. And eventually, your brain makes you do something to stop the pain. You sell, you move to cash, you lock in the loss. So if you're retired or close to it, and you're checking your account every morning with your coffee, you're setting yourself up to fail. Check it once a quarter, maybe twice a year. That's it. If you've built the right structure, the buckets I just talked about, there's nothing you need to do on a daily basis anyway. Now, let me tell you a quick story about a guy who understood this perfectly. I met him at a conference in 2012. He was 78 years old, retired from Boeing in 1993, lived through the 2000 crash, the 2008 crash, and everything in between. I asked him how he handled 2008. He said, I didn't. I asked what he meant. He said, I didn't open my statements for a year and a half. My wife wanted to. I told her no. We had our cash bucket. We knew we were fine for 3 years, so I just didn't look. Opened them in late 2009, and we were down 12% from where we started. That's it. 12%. Because we had bonds and they went up while stocks went down, and we rebalanced once mechanically, bought more stocks when they were cheap, and by 2011, we were at new highs. That's the whole game. He didn't do anything fancy. He didn't time the market. He didn't have some brilliant strategy. He just built a structure that let him ignore the noise. And ignoring the noise, as it turns out, is worth about 4% a year in returns. Here's the other thing smart retirees understand that most people don't. Volatility is actually good if you're set up for it. I know that sounds insane, but think about it. If you've got your time bucket set up and you're rebalancing once a year, what are you doing? You're selling whatever went up and buying whatever went down. When stocks crash and bonds hold steady, you sell some bonds and buy stocks at a discount. When stocks rip and bonds lag, you sell some stocks and buy bonds. You're forcing yourself to buy low and sell high mechanically, without emotion, without trying to predict anything. Warren Buffett has been saying this for 50 years. Be fearful when others are greedy, and greedy when others are fearful. But most people can't do it because it feels wrong. It feels stupid to buy stocks when the market just dropped 30%. Your brain is screaming danger. But that's the whole point. The time when it feels the worst to buy is usually the best time to buy. And the time when it feels the safest to buy, when everyone's excited and the market's hitting new highs every week, that's usually the worst time. This is basic human psychology. We're wired to follow the herd. In our evolutionary past, that kept us alive. If everyone in your tribe started running, you didn't stop to analyze why. You ran too, because the ones who stopped to think got eaten by the lion. That instinct is baked into your brain. But in investing, the herd is usually wrong at the extremes. When everyone's buying, prices are high. When everyone's selling, prices are low. So to actually make money, you have to do the uncomfortable thing and go against the crowd. And most people, even smart people, can't do it. But here's the beautiful part. If you build the right structure, the time buckets, the rebalancing plan, you don't have to be brave. You don't have to overcome your instincts. The system does it for you. You're just following the plan. Selling bonds, buying stocks, mechanical. No emotion, no heroics. And over time, that's how you win. Let me show you what this actually looks like over the long term, because I think this is the piece that finally makes people stop stressing. Let's go back to January of 2000. Absolute worst time to start investing in the last 30 years. Dot-com bubble is about to pop. You put in $1 million, 60-40 portfolio. Over the next 25 years, you lived through 3 massive crashes. Dot-com, financial crisis, COVID, multiple wars, a pandemic, political chaos, half a dozen reasons to panic and sell. But you don't. You rebalance once a year. You ignore the headlines. By the end of 2024, that $1 million is worth $4.2 million. Through all of that, and if you'd sold during any of those crashes and missed the recovery, you'd be nowhere close. That's the data nobody shows you. They show you the scary charts, the concentration risk, the yield curve inversions, the Buffett indicator, all the reasons to be worried. But they don't show you the chart that matters most. The one that says, if you just hold on through the bad times, the long-term trend is up. Always has been. Might not always be, who knows, but it has been for 100 years. And betting against it has been the losing move almost every single time. So when you ask me if you should be worried about a crash in 2026, here's my answer. I have no idea if there's going to be a crash next year. Nobody does. Anyone who tells you they do is lying to you or to themselves. But here's what I do know. If there is a crash, it will recover. It always does. And the people who make it through are the ones who built a structure that lets them hold on when everyone else is panicking. That's it. That's the whole secret. It's not complicated, it's just hard. Because it requires you to go against every instinct you have. To not sell when you're scared. To not chase returns when everyone's getting rich. To be boring when boring feels like losing. I'll leave you with this. I've been tracking market psychology for over a decade. I've read thousands of SEC filings. I've watched hundreds of investors make the same mistakes over and over. And the pattern is always the same. What 99% of people do is usually what not to do. When everyone's buying, be cautious. When everyone's selling, be greedy. When everyone's checking their accounts every day and panicking, close your laptop and go for a walk. The retirees who stop stressing about investing aren't the ones who figured out how to predict crashes. They're the ones who built a plan that works regardless of what happens next. They separated their money into time buckets so they never have to sell stocks in a downturn. They rebalanced mechanically so they're always buying low without having to think about it. And they stop checking their accounts every 5 minutes so their brains don't trick them into making emotional decisions. Do those 3 things, and you'll sleep fine no matter what 2026 brings. Because the market will do what it does, but you'll be ready for it. And that's the only edge you need.